Hello and welcome to Shamrock Asset Management Investment Update Series. My name is Kevin Caldwell, President and CEO here at Shamrock. I'd like to do two things today. Number one, talk about the fixed income landscape in the current environment, and two, what can investors expect from the fixed income environment going forward. Fixed income over the last 10 years has had a tremendous run, outpacing both the U.S. equity market and foreign developed market as well. Here with me today is Tom Hagstrom, Head of Investments for F Squared out of Massachusetts, as well as Dave Hoener, Chief Investment Officer here at Shamrock. Well, let's sit down with Tom and ask him some questions. Tom, let's start with you. Fixed income has always been perceived to be a safe haven. With the inevitable rise in interest rates and the potential principal risk that comes along with that, how has the risk profile changed for fixed income in recent years?
Well, it's interesting. I would know sometimes people have noticed what happened to the income in fixed income. It was almost like it was the victim of its own success. We began, in the 80s with double-digit yields, and the total return that an investor enjoys is obviously, part the coupon interest or the yield that is part of the portfolio, but it's also principal appreciation, and you get that when interest rates fall. So unfortunately, now, while we benefited in the past from having interest rates fall, now we're in a situation where both the yield in the traditional fixed income securities is very low, so it's not providing a lot of income, and the potential for principal loss increases because there isn't that income cushion that we used to rely upon.
Fed Chairman Ben Bernanke recently reaffirmed the commitment to keep interest rates low through 2014. He also made it evident that if the U.S. economy begins to stutter, that they're waiting in the wings to step in and do what they need to do to support that. With additional measures, or what additional measures could Mr. Bernanke take in the form of quantitative easing, and what's the impact on markets?
Well, they've seemed to have been very open with a lot of different approaches, whether they be purchasing treasury securities in the twist to try to bring interest rates down in the long end of the curve instead of, they've obviously brought interest rates down to zero in the front end of the curve. They've also had some programs where they've purchased mortgage-backed securities in order to get the refinancing rate down. So they're not shy about being an intermediary when markets seem to become dysfunctional. But I think what's really important for investors to take in mind is the fact that at some point they're going to exit those programs. At some point there's going to be a need and a desire to move to let market factors take hold, and when they think that that's strong enough, that may mean a significant increase in rates and maybe over a short period of time, which again would go to your point earlier, that maybe there's more risk in fixed income than people are thinking about.
Tom, you've talked about the U.S. government being big buyers in the Treasury market and U.S. debt in general. What happens? What's the major impact when the U.S. government is no longer the largest buyer in that market?
Well, we saw what happened with Greece, and that's obviously an extreme. Right now, domestically, we're able to finance about 83% of the national debt, but we are looking for overseas buyers to pick up the balance of that. You find yourself in a very tricky situation, and you begin to lose investor confidence very quickly when those numbers begin to add up. So again, that's something that we know isn't going to probably take effect and have it won't be something that'll be a drastic effect over the course of the next 6 months. But over the course of the next 4 or 5 years, I'm certain that it's going to continue to be a focus.
We've talked a little bit about U.S. debt. How about on the emerging market side? Do you foresee there's an opportunity for emerging market debt in client portfolios today?
I do. I mean, there's a lot of, when I first began working on the buy side of the fixed income business, it was a very interesting time. Emerging debt had to be backed by U.S. Treasuries. There was a program that was started by the then Treasury Secretary Brady in order to get have emerging markets have access to the dollar market. So people were buying bonds. They were looking for the emerging government to pay the coupon, but the principal was backed by U.S. Treasuries. as those economies improved and as they got their fiscal act together, they were actually able to go out and buy back those Brady bonds and issue straight sovereign debt. And now it's been a terrific success story. I'm sure part of it is the increased globalization and the growth in Asia, where they've been looking and being able to purchase raw materials from those emerging markets. But there's a ton of opportunity and ton of growth potential, and I think that that's something that investors should certainly consider going forward.
Well, Dave, let's bring you into the discussion now. Shamrock Asset Management has for a long time managed equity and fixed income portfolios for clients. What opportunities and strategies are you seeing that are relevant for clients today in fixed income?
Well, Kevin, I really appreciate the opportunity to be here today. And as you heard Tom expound on a few of the questions earlier, what we were talking about off camera before the session really brings into focus. And quite frankly, what is happening today, in a way, is even more difficult than it was in the debacle period of 2008, 2009. So what we have developed for our client base, especially older individuals who have reached a retirement age or are focusing on retirement in the next 3 to 5 years, we've taken a very simple, straightforward approach in creating a ladder of 3 to 5 year maturities, suffering and taking a low interest rate coupon, or in fact even sprinkling a few higher yielding, very high quality corporates in that part of the ladder, so that the money is available when we see that time period when perhaps interest rates will start going back up, and we will then have the opportunity to begin to recommit and go longer in order to achieve a high level of income.
Dave, thank you very much for those thoughts. And with that, we'll wrap up this investment update. I'd like to thank Tom and Dave for your insights and thoughtfulness. And for all of you, we hope this was relevant and timely. Thank you for your time. And if there's anything we could do to help, let us know. Thank you.